Welcome to Investing Foundations. In this module, we will build the vocabulary and mental models that support the rest of an investments course. We will distinguish real assets from financial assets, see how markets move savings toward productive uses, and examine the choices investors make about risk, return, and management style. We will also connect those ideas to governance, financial intermediaries, and the 2008 financial crisis. The slides are intentionally visual and concise. The narration carries the explanation, so focus on the relationships among ideas rather than trying to copy every word. Imagine that you receive $5,000 after your current bills and emergency needs are covered. You can spend it, hold it as savings, or invest it. Spending creates value now. Saving preserves flexibility. Investing gives up some current consumption in the hope of greater future consumption. That future benefit is not guaranteed, so the decision also introduces risk. This simple choice captures the nature of investment. We shift resources through time, accept uncertainty, and expect compensation for waiting and bearing risk. Keep this scenario in mind as we move through the chapter. This module has 5 outcomes. First, you should be able to separate productive real assets from the financial claims written against them. Second, you should be able to explain the economic roles of markets, including moving purchasing power through time, allocating risk, and directing capital. Third, you should be able to distinguish broad portfolio decisions from individual security choices and connect those decisions to active or passive management. Fourth, you should know the major participants and the difference between primary and secondary markets. Finally, you should be able to explain how incentives, leverage, and interconnectedness contributed to the 2008 financial crisis. The module is organized around 5 connected questions. We begin with the nature of assets. Then we ask what financial markets contribute to the economy. Next, we move inside the investment process to separate asset allocation from security selection and to compare active and passive approaches. We then identify the people and institutions that move funds through the system. Finally, we examine how the same connections that make finance useful can transmit stress. The point is not to memorize isolated definitions. It is to build a map that lets you explain how a decision in one part of the system affects another part. Real assets are the resources that create goods, services, and productive capacity. They include buildings, equipment, technology, inventory, and human capital. Financial assets are different. A stock, bond, deposit, or mutual fund share is a claim. Its value comes from the cash flows or income generated by real activity. This distinction matters because an economy's ultimate wealth depends on its real assets. Financial assets help us divide, transfer, price, and finance claims on that wealth. In other words, financial assets are the contracts that connect savers to the productive uses of capital. A financial asset cannot exist in isolation. When an investor owns a bond, the issuer owes the promised payments. The same contract appears as an asset on one balance sheet and a liability on another. When we aggregate all domestic balance sheets, those internal financial claims largely cancel. What remains is the economy's stock of real assets and its net claims on the rest of the world. This balance sheet identity is useful because it prevents double counting. It also reminds us that financial engineering can redistribute claims and risk, but it does not by itself create factories, homes, technology, or skills. Financial markets perform 4 broad functions. First, they move purchasing power through time. Savers can postpone consumption, while borrowers can finance education, homes, or business investment today. Second, markets allocate risk by offering claims with different payment priorities and exposures. Third, market prices aggregate information and expectations, helping participants compare opportunities. Fourth, secondary markets provide liquidity, which makes long-term claims easier to hold because investors can often sell before maturity. These functions are related. Better information and liquidity can reduce financing costs, while poor incentives or fragile liquidity can make the entire system more vulnerable. Asset classes group investments with similar economic characteristics. Cash equivalents emphasize liquidity and stability. Fixed income securities promise contractual payments and generally sit ahead of equity in the capital structure. Equity represents ownership and receives the residual cash flows after other claims are paid. Derivatives take their value from an underlying asset, rate, index, or event. They can reduce risk or magnify it. Alternatives include categories such as private markets and real estate, often with different liquidity and valuation features. The labels are useful, but risk always depends on the specific instrument, price, leverage, and role in the total portfolio. Income and desired consumption do not always move together. Students and young households may need to borrow or use savings before earnings peak. During working years, income may exceed current consumption, creating the capacity to save and invest. In retirement, accumulated assets can support consumption after labor income falls. Financial markets make this smoothing possible by connecting people with different timing needs. The chart is conceptual rather than a prescription. Real life is irregular, and households face taxes, emergencies, inflation, and uncertain longevity. The central idea is that saving and investing shift purchasing power across time. Investors can choose among securities with very different risk profiles. An insured deposit and a leveraged derivative position may both be financial assets, but they behave very differently. Risk is not simply a label attached to an asset class. It depends on price sensitivity, credit quality, liquidity, diversification, and leverage. A suitable exposure should match the investor's goal, time horizon, liquidity needs, and ability to absorb loss. This is why a higher expected return is not automatically better. The relevant question is whether the additional expected return is adequate compensation for the risk and whether that risk belongs in the portfolio. Financial markets have an informational role. New information changes expectations about cash flows and risk. Investors respond, prices move, and required returns change. Those required returns become financing costs for businesses and governments. A lower cost of capital can make more projects economically attractive. A higher cost can delay or cancel investment. This is one reason market prices matter beyond the trading floor. However, prices are not perfect measures of fair value. Information can be incomplete, incentives can be distorted, and liquidity can disappear. Markets are powerful mechanisms for coordinating decisions, but they still depend on institutions, disclosure, competition, and trust. Large organizations separate ownership from management. Shareholders and lenders provide capital, while managers make operating and strategic decisions. That division is efficient, but it creates an agency problem when managers' personal incentives differ from the interests of capital providers. A manager might pursue growth for prestige, avoid a value-creating takeover to preserve control, or take risks that benefit equity holders while harming lenders. The point is not that managers always behave badly. The point is that contracts and governance must anticipate conflicts. Incentives, monitoring, disclosure, and the possibility of replacement are mechanisms for aligning decisions with the interests of investors. Markets and businesses require trust, but trust is not the same as blind faith. It is supported by incentives, oversight, and transparency. Compensation and ownership can align managers with investors. Boards, auditors, creditors, and regulators provide monitoring. Reliable financial reporting helps investors compare opportunities and price risk. When these mechanisms fail, the cost spreads beyond the firm. Participants demand more verification, contracts become more complex, financing becomes more expensive, and public confidence falls. Ethical behavior therefore has an economic function. It reduces friction and helps the system operate with fewer costly safeguards. 2 U.S. reform milestones illustrate how regulation responds to breakdowns in trust and stability. The Sarbanes-Oxley Act of 2002 strengthened executive accountability, internal control reporting, and audit oversight after major accounting scandals. The Dodd-Frank Act of 2010 followed the financial crisis and addressed systemic risk oversight, consumer protection, derivatives transparency, capital, liquidity, and resolution planning. Regulation can reduce specific vulnerabilities, but it also imposes costs and can shift activity to less regulated parts of the system. Good analysis therefore asks both what problem a rule is designed to solve and what new incentives the rule may create. A disciplined investment process begins with the investor, not with a product. Goals define what the portfolio must accomplish. Constraints include time horizon, liquidity needs, taxes, legal limits, and risk capacity. Those inputs support an investment policy which guides asset allocation and security selection. After implementation, the work continues. Market movements change weights, goals can change, and assumptions can be wrong, so the portfolio must be monitored and rebalanced. Thinking in cycles helps prevent performance chasing. It also creates a record of why decisions were made, which is essential for evaluating results fairly. Asset allocation is the decision about how much of the portfolio belongs in major categories such as equity, fixed income, and cash. It sets the broad risk budget, identifies the main sources of expected return, and determines how much liquidity is available. The percentages on this slide are illustrative, not a recommendation. A suitable allocation depends on the investor's goals and constraints. The important distinction is that allocation is a portfolio-level choice. It asks how the pieces should work together before asking which specific stock, bond, or fund should fill each piece. Security selection happens after the broad allocation is defined. Within an equity allocation, the investor might choose individual stocks, an index fund, an actively managed fund, or a combination. Analysis asks whether expected cash flows, risk, and price create an attractive opportunity, and whether the security fits the portfolio. A top-down process begins with the economy and asset classes, then moves toward industries and securities. A bottom-up process begins with individual opportunities. Either approach can be disciplined, but the analyst must avoid confusing a good company with a good investment. Price always matters. In competitive markets, assets with higher expected returns generally expose investors to greater uncertainty or less favorable characteristics such as illiquidity. The word expected is essential. It describes an average across possible outcomes, not a guaranteed result. Risky assets can lose money, and a high expected return does not make every purchase attractive. Price also matters. Even a high-quality asset can become a poor investment if the price implies unrealistically strong future performance. The risk-return trade-off therefore combines uncertainty, valuation, and the investor's ability to tolerate outcomes that differ from the expectation. Diversification works because investments do not all respond to the same events in the same way. When two assets are imperfectly correlated, a weak outcome in one may be partly offset by a stronger outcome in the other. Combining many exposures can reduce company-specific or sector-specific risk and create a more consistent portfolio. Diversification does not eliminate all risk. Broad market shocks can affect many assets at once. Correlations can rise during stress, and an overpriced portfolio can still disappoint. The goal is not to own as many securities as possible. The goal is to combine exposures whose risks are not redundant. Market efficiency is a hypothesis about how quickly and fully information is reflected in security prices. A weak form focuses on past prices and trading data. A broader form includes public information such as financial statements and news. A strong theoretical form includes all information, even private information. The practical implication is that investors compete to exploit mispricing, and their trading can push prices toward fair value. Efficiency does not mean that prices are always correct or that bubbles cannot occur. It means that consistently identifying and profiting from errors is difficult after costs, taxes, and risk are considered. Active management seeks to outperform by identifying mispriced securities, shifting asset weights, or timing markets. Passive management seeks to capture a benchmark's return with minimal deviation, cost, and turnover. Active strategies can add value if skill is real, persistent, and large enough to overcome costs. Passive strategies accept market prices as a practical starting point and emphasize diversification and discipline. the choice is not purely philosophical. It depends on the market segment, available skill, fees, taxes, governance, and the investor's objective. Many portfolios combine a passive core with a limited number of active decisions. The major players have different funding positions and objectives. Households are often net savers, although they also borrow for homes, education, and consumption. Business firms are often net borrowers because they finance productive assets. Governments can borrow or save depending on fiscal conditions. Financial intermediaries connect participants by transforming the size, maturity, liquidity, and risk of claims. The system includes both direct finance through markets and indirect finance through institutions. Funds flow one direction, while securities and contractual promises flow the other. Understanding these links is essential because risk can also travel through the same network. In a primary market transaction, an issuer creates and sells a new security. The cash flows to the issuer and can finance investment, operations, acquisitions, or refinancing. Investment banks often advise, market, and underwrite the issue. In a secondary market transaction, investors trade securities that already exist. The issuing firm usually does not receive the cash from that trade. Secondary markets still matter to issuers because liquidity and price discovery can make primary securities easier and less costly to sell. The two markets are therefore distinct but mutually reinforcing. Financial intermediaries issue claims that are convenient for savers and use the proceeds to finance borrowers or invest in securities. Banks transform deposits into loans. Insurers pool premiums and invest against future claims. Pension funds convert contributions into long-term portfolios. Investment companies pool many investors' money into funds. This transformation can change maturity, liquidity, denomination, and risk. Investment banks play a related but distinct role by specializing in primary market transactions, advisory work, underwriting, and distribution. Intermediation creates value, but it also concentrates balance sheet risk and creates dependencies that matter during stress. Venture capital and private equity invest in companies that are not publicly traded. Venture capital usually focuses on younger firms with high uncertainty, limited operating history, and substantial growth potential. Investors often provide expertise, networks, and governance as well as cash. Private equity more often invests in established businesses and may seek control to improve operations, change strategy, restructure financing, or support growth. Private market investments are typically less liquid and valued less frequently than public securities. Their returns also depend heavily on manager skill, deal structure, leverage, and the ability to exit the investment. The 2008 crisis emerged from a chain of reinforcing vulnerabilities. A housing boom increased demand for mortgage credit and mortgage-linked securities. Underwriting weakened, borrower leverage rose, and securitization spread complex claims across the financial system. Institutions used substantial leverage and relied on short-term funding, while investors and rating systems often underestimated tail risk. When house prices fell and defaults increased, losses reduced capital and confidence. Funding markets froze because participants doubted collateral values and counterparty strength. Forced sales pushed prices lower, which created additional losses and tightened credit. The crisis was systemic because these mechanisms interacted. Systemic risk is not simply the possibility that one institution loses money. It is the possibility that distress disrupts core financial functions and spreads through counterparties, collateral, funding markets, asset prices, and payment systems. Highly leveraged institutions have less capacity to absorb losses. Illiquid assets are difficult to sell without moving prices. Short-term funding can disappear quickly. The crisis therefore highlighted the importance of capital, liquidity, transparency, incentive design, and credible resolution mechanisms. A useful lesson is that risk does not vanish when it is transferred. It moves to another balance sheet and the network determines what happens next. Now apply the chapter's framework to a simple case. Jordan is 30, has an emergency fund, and is investing for a long-term retirement goal. Before choosing any fund or security, Jordan should define the goal, time horizon, liquidity needs, risk capacity, broad allocation, and review rule. The result can be summarized in a short policy statement that explains what the portfolio is designed to do and how it will be managed. This statement becomes a decision filter. It helps Jordan reject products that do not fit the plan and reduces the temptation to change strategy in response to headlines or short-term performance. Pause here and answer the 4 questions before continuing. For question 1, identify which item is productive capacity rather than a financial claim. For question 2, remember the difference between a new issue and trading an existing security. For question 3, think about which type of risk can be offset by combining imperfectly correlated assets. For question 4, return to the investment process cycle. The correct answers are 1. B. A factory. 2. B. The selling investor. 3. A. Asset-specific risk. 4. B. Define goals and constraints before choosing securities. The chapter can be reduced to 6 durable ideas. Real assets create productive capacity, while financial assets divide and transfer claims. Markets support timing, risk sharing, information, and liquidity. Governance matters because control and ownership can diverge. Asset allocation sets broad portfolio exposure, while security selection chooses the instruments inside it. Expected return is compensation for uncertainty, and diversification can reduce redundant risk. Finally, financial connections are double-edged. They make the system useful, but they can also transmit distress. These ideas will reappear throughout the course in portfolio theory, bond analysis, equity valuation, derivatives, and performance evaluation. You have completed the introductory module. The next step is to examine securities, trading mechanisms, and formal measures of risk and return. The redesigned deck paraphrases and reorganizes the concepts from the original Chapter 1 presentation, while replacing dense tables and dated visual examples with conceptual diagrams and application prompts. The speaker notes contain a complete narration transcript, and the accompanying narration kit separates the script into one file per slide. Before publishing, review the examples in your own teaching voice, generate the audio with your private 11 Labs voice, verify pronunciation and pacing, and provide the transcript alongside the narrated presentation in the learning management system.